The Reserve Bank of India's 25 basis point rate hike on Wednesday came in line with expectations. However, it did not leave the bond market particularly enthused as the central bank maintained its policy stance with a hawkish undertone and without giving any firm indication of a possible pause in the rate hike cycle going ahead. Bonds weakened with the yield on the benchmark 10-year government security rising 4 basis points to 7.35% as RBI Governor Shaktikanta Das reiterated his concern on sticky core inflation, which is easing at a slower pace. Economists read this as the RBI leaving room for further rate hikes ahead if inflation exceeds its projections. According to Dr. Aurodip Nandi, economist at Nomura, the RBI governor's communication struck a somewhat hawkish note, flagging concerns on high core inflation, projecting confidence on growth, and flagging that monetary policy conditions are still not as tight as pre-pandemic levels. This does not bolt the door completely on further tightening. The policy arithmetic has changed from de facto policy tightening to a distinctly data-dependent mode. Our baseline view is a pause hereon. Besides, last week bond traders had cheered the budget's announcement of gross market borrowings of 15.4 trillion rupees for FY24, below the estimates of 16 trillion rupees. This led to the yield on the 10-year benchmark government bond settling at the lowest closing level since December 15, 2022. As an investment strategy, Puneet Pal of PGIM India Mutual Fund suggests investors increase their exposure to short-duration products while selectively looking at dynamic bond fund categories as per their risk appetite.
So today's RBI's monetary policy was slightly more hawkish than expected. Market participants were expecting a 25 basis rate hike, which was delivered by RBI, but there was no change in the monetary policy stance, which was retained at withdrawal of accommodation. Some market participants were expecting a change in stance to neutral, which did not happen. Though RBI did mention that real rates are now in positive territory. So we think that RBI did not want to give any forward guidance in respect of rates, given the various uncertainties, especially global uncertainties. So RBI did mention about global uncertainties and also the fact that they want to retain the flexibility in terms of conduct of monetary policy, and that's why they did not change the stance nor give any forward guidance. So we think that going forward, the bond markets will continue to trade in a range. We expect the 10-year bond yield to trade in a range of 7.20 to 7.5 till March end. Overall, coming to the budget, the borrowings are higher than last year. But given the fact that FY23 borrowings by and large were non-disruptive in nature, we think FY24 borrowings will also sail through.
That said, equity markets will seek direction from their global peers today. Q3 earnings of LIC, Zomato, Bajaj Consumer, IRCTC, Lupin and MRF will also be on the radar.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.